trading. Now, when we actually talk about technical analysis, we have various methods people do it. We have people who use combination of indicator-based strategies, moving average, RSI, this, that. If you even check my YouTube channel, you will see some strategies, probably indicator-based strategies, another time me explaining without any indicator. Now, for a fact, there is no doubt, for a certainty, the best technical analysis concept should actually revolve around price itself, not around some series of indicators showing overbought or oversold. If you want to really develop good level of consistency, you should learn how to read price by itself. That is the language of the market. So one of the basic ways to read price by itself is two major ways actually: the candlesticks and the structure. Now, there are a lot of information about candlesticks on YouTube, over the internet, and everywhere. I'm sure a lot of us, or every one of us in this call, knows about candlesticks. So we are not really going to be dwelling on that because that's not like our major focus in this particular series. If you are curious enough, you can actually go online and read all up about candlesticks, but that's not what we're going to be focusing on in this particular series. So what we will focus on here is actually market structure. So when we talk about market structure, we're talking about the narrative and the flow of price. Like, what is the story behind this movement of price? What can I do with it? What is price telling me? So the market structure is simply the language of the market. The candlestick individual representation of price action, but when you put all of the candlestick together and try to study it, what you have is a structure, and that actually is what is your market language. Now, understanding the market structure from past price action and even to current price action will give you possible clue of where price is supposed to trade to. So with your understanding your market structure, at least you will be able to know which side is high probability side to be in any given market. Now, let us be rest assured that this market we are trading is actually a random market. Otherwise, we will have a strategy without stop loss and 100% accuracy. But that is not what I'm trying to drive at here. We don't have such strategy with 100% accuracy that you can actually trade without stop loss. But having a solid basis of the markets and its structure, understanding the candlestick will give you an edge and probably increase your probability of going into trade from 50-50 to probably 60%, 70 or so. Yeah, so basically when we talk about market structure, it is something we all already know but probably don't apply. So when we talk about market structure, we are simply talking about the market models we already know as the bullish markets, the bearish markets, and the consolidating markets. Yeah, so these actually are your market structure. Now, given how simple this concept is, it is one of the major things you need to understand for you to actually be a good technical analyst. For example, I used to be a trend line trader, but when I studied my market structure, practiced, and started trading with it, I could foretell a trend line that is about to break. Like, I'll have high probability knowing that this trend line is about to break. All of these informations are actually embedded in your market structure itself. Now, let's actually dive into our chart and look at some market structures and how we can apply them. Now, talking about the bearish market structure, I mean the 30-minute time frame, and this is volatility 10 index, where I am analyzing from is tradingview.deriv.com. Fine. Now, this session here from this point down to somewhere around here, This is an example of our bearish market structure. Now, what are the characteristics of bearish market structure? Just like we know from theories, bearish market structure is supposed to have lower highs and lower lows. This point we have a swing high, this point a low, a lower high, a lower low, a lower high, a lower low, and this actually is why this is a bearish market structure, because the highs to your right are lower and the lows to your right are also getting lower. I made mention of swing highs and swing lows. Now, when I say swing high, I'm simply referencing to the maximum point the price got to before it started trading down. So all of these swing points are how you actually identify your market structure. So if the swing highs are actually reducing to your right side, that means that market is bearish. And if they are increasing to your left side, it means that particular market is bullish. Because yeah, so I'm looking for a textbook example, like a very simple example that will mirror a bullish trend like this. Yeah, so let me use this particular point as a textbook example. You might not always have textbook setup all the time, like the very basic and simple setups, but I will need them for illustration. So the market might present something more difficult, but I need the simplest forms for illustration. Fine. Now, this is a typical bullish market structure. Typical bullish market structure. Why? Because the swing points, the lows are getting higher to the right side, and the highs are also getting higher to the right side. So this is a typical example of a bullish market structure. Now, what is the application of all of this that I've been talking about, the market structure? Now, take a look at this particular structure. If you can ascertain that this particular structure is bullish, it means you already have high probability of knowing that the market is expected to trade toward just one direction. Now, for most people, this is where they come and probably fix trend lines and all of this kind of stuff. Yeah, but just by looking at the market structure, identifying the swings, I can guarantee you that you are good, like without drawing multiple lines on your screen. Just watch the structure. Now, let us apply this structure for looking for continuation trades. So for example, you've seen point A here, a low, and then point B, a high. Let me quickly talk about this. You can actually switch to line chart for you to see your structure clearly if you're having a bit of confusion about identifying a swing point in your market structure. So back to analysis. Fine. Now we have a low here and a high here. Now we have another low here, which is an equal low to this low, but not actually a lower low to the right. But now we have a higher high to the right side after this previous high. So this point is what we will label as a break of structure. This is a break of structure because we had a bearish structure, but now we have a break to the higher side. Now this has actually given you some validation that this bearish trend has come to an end, either temporarily or fully. So if it is a temporary end, that will be a beginning of retracement. If it's a full end, that will be a whole reversal into a full bullish trend. Yeah. Now the point here is this. This is your stereotypical bearish trend, lower highs and lower lows. But what we have here is a bearish trend with a higher low. So this is abnormal for a bearish trend. A higher low is abnormal for a bearish trend. So we already know that this market is probably gearing up to become bullish by seeing this kind of setup. Now, if you want to actually mark a break of structure this way, you want to make sure that this previous high is traded above with good and sustainable momentum. Fine. Now, after seeing this break of structure here, what happened here? price traded and not violating this low. So you've taken out one part of the market that price is not supposed to trade to. So just applying the structure, you should know what you should be trading from just the structure. So let's say after seeing this break and somehow you missed this, you still have opportunity again. Probably you missed this move. You still have opportunity to trade this particular section again, putting your stop loss below this low and looking for an entry close to this previous low. There are various things we put into consideration to pick our entries, which we might not really be deliberating on right now. So we can actually finish on the structure itself. Yeah, but your lower quarter of the previous swing, you look for your entries there and boom, to the upside. So knowing the market structure will actually guide you to trade toward the right direction of the market. There is this popular saying that the trend is your friend. So for the trend to actually be your friend, you need to understand the trend, which is the structure itself. This is a bullish trend, also a bullish market structure. So for the trend to be your friend, you need to understand it. Now, seeing that this market is giving you higher highs and higher lows, there is no doubt you wouldn't want to jump in and sell this particular trend unless there is an abnormality to it, probably the opposite of this. Now, this is a bearish trend, and then it had a higher low to a higher high to the right of it, and what came up next was a higher low and then a higher high. Now, until that particular bullish trend shows an abnormality, you are not supposed to sell it. Applying just the market structure, no indicator, no lines, nothing involved. Fine. So all you need to master is identifying your swing points. Now, let us look for what I meant by abnormality in our trend. If you look at this particular point, there is a swing low here. This is 30-minute time frame, and your bullish trend is supposed to give you higher highs and higher lows. But considering this particular low here, this swing low here, projecting it forward, what is here? You can see that this low has been violated. So that means the bullish trend, this particular trend now have a structure that looks like this. So this is no longer a bullish trend. This actually is no trend yet, but this signifies that probably this bullish trend has come to an end. That is why we saw this particular price action here. So this is something you want to be looking out for to trade reversals in the market. This particular combination of a particular trend. So you can see the bullish trend, a low in a bullish trend being violated here. Now, after seeing this, what do you want to wait for? Retracements back to the upside, and then you sell. Now, this retracement, take note of this particular part. This is your previous swing high. This is your previous swing low. Now, this was a bullish trend. You anticipate a bullish trend not to give you a lower high and a lower low. Now, since this bullish trend has given us a lower low, we anticipate that it will not likely give us a higher high. So there is no structure actually like this in the marketplace unless there is a hunt for liquidity from both sides of the market. So by default, this is no structure. This is neither bullish nor bearish market. So there is no structure like this in the marketplace. But price will always trade like this time and often because the market is actually a random place. But from understanding what is supposed to happen, but price can actually deviate from it. Understanding what is supposed to happen, we are not supposed to have a follow-up higher high. So anticipating this, you've also taken out some perspective of the market. Now you are left with few options. And after seeing this, your few options will be to sell this market because you anticipate a lower high since you already have a lower low. This is just following the structure. So price actually moves like a snake. So if a snake is moving, if it heads moves toward this direction, the whole body will follow. If it heads move toward this direction, the whole body will follow. And you won't actually see snakes moving in a straight trajectory like this. Instead, probably you see this minor move side to side, but they're going up. This is how they move. That's how the markets also move. You see it moving up, down, but it's going down. Now, because the market is in a bearish trend, doesn't mean the markets will not trade back up. Because it is in a bullish trend, doesn't mean it will not sell. Fine. So you can see this bullish trend being broken here, a low in the bullish trend being violated, not just a kind of small violation, but a massive one, impulsive violation to the downside. And once you see this kind of impulsive violation, this is a very good signal that the previous trend has been broken and has changed. Broken and changed. Now, from this point, you could see higher low and then a lower high violation, and then markets continue to sell, give you bearish trend up until this point. So you see lower high, lower high, a low, then a lower low, a lower high, lower low, lower high, lower low. So no doubt from this particular session to this session was a bearish trend and could have given you ample opportunities to jump into a trade, seeing that the trend is now bearish. Now, switching to the other side of it, you can see this bearish trend up to this point. We had a higher high. From having lower lows and lower highs to this point, we had a higher high. And then what happened? You see market failing to trade back to this previous low. So this particular move here was an abnormality in a bearish trend, and that resulted to a full-scale reversal in the market. So you can see how effective the market structure is. Now, the market structure is not going to be perfect or this simple every time, but as a trader, you're not supposed to be trading every time. You don't need to be attempting to catch point and pips every single time in the market. If let's say you're in the military and probably a marksman, a sniper, are you going to be taking random shots every single time? Nope. You're only going to be shooting when your target is locked and you are sure that you can hit your target. So that is how you are supposed to trade too. So if you look at the market and the structure is not understandable, then you can decide to leave it until the market prints something that is understandable. If it's possible, this is the market we will live all through our life, and die of the market will still be there trading 247. So we need to be patient. Our aim of trading is to make profit, not just to trade. So when the market is not trading in a pattern we understand, we want to wait until it forms a pattern that we can understand. Take note, I've not actually been illustrating anything on head and shoulders, this, that. It's just the basic, what you already know, what your bullish trend is supposed to do and what your bearish trend is supposed to do. And there is actually no use of indicators in this particular section. So all you want to do is learn how to identify your swing points, and try to see if your market, even when the structure is a bit confusing, try to see which structure is actually playing. Now, sometimes your structure might not be clear in a particular time frame. Let's say you are in okay, this one is very clear actually. So let's say you are in a particular time frame, probably 1 hour time frame, and your structure is not actually clear. You can navigate to a lower time frame. Probably you were in, let's say you were in H4 and the structure there was not actually clear. You can navigate to H1 or 30 minutes, 15 minutes, and then you probably see a structure that is clear and where you can actually execute trades from. Now, why does that actually happen in the marketplace? Now, this actually is a 30 minutes candle. So all the transactions that actually happen in this particular candle, they occurred in 30 minutes. Now, if you actually look at your time frame, we have 1 minute. So we'll have 31 minute candlesticks embedded in this specific candle here. So 31 minute candlestick, you won't be seeing 30 consecutive bullish candlesticks. Actually, you see some bullish, some bearish, some bullish, some bearish. In that case, you will have a trend. here, when you go into 1 minute time frame, you see a trend here in this particular candle. So it's definitely going to be a trend of higher highs and higher lows. But in a higher time frame, this is just one candle. So once your structure is confusing, all you have to do is to stretch your time frame. Just if you are in a high time frame, just stretch it to a lower time frame. And if it's confusing you from a lower time frame, then try to compact the information and navigate to a higher time frame.